name is Julie Saltman. I'm a CPA and a director and owner of a Brisbane-based financial management and taxation accounting practice. Given the time of year, the thing I want to talk about today is tax planning. However, tax planning for larger small businesses. An entity that does not come under the small business entity rules. And obviously that's the kind of thing you need to get advice on. The most basic concept of that is more than $2 million turnover of the businesses I'm talking about, but it had other issues, that rule. So tax planning for larger businesses pretty much is no longer a 30 June, well, it hasn't been for some time, a 30 June quick fix. It's a whole year process. And the reality is, tax is a cost of running a business, and the best thing to do with tax, if you view it that way, is to treat it like other cost and manage it. And in fact, there's possibly other costs that are more important to manage more diligently. But tax is a cost that should be managed. But the golden rule is, don't waste a dollar just to save 30 cents. Some of the things that were done to save 30 cents worth of tax just wasn't worth it. So there are still some things that you should look at before 30 June's over. So they are things like review your debtors. Have you got bad debts in there that really need to be written off? You've done everything you can to recover them, but they're still on your books. Get rid of them. Stock review, when you do a stock take, and you obviously need to do a stock take, but just review your stock from a point of view is what's obsolete, what shouldn't be there anymore, what is the valuation of that stock, is it below cost. You know, there is rules around how to value stock that need to be considered as well, and you might be best certainly to go and talk to your accountant as to what works for you. Or at least get yourself set up so that you are able to give yourself those choices. The other thing to look at is your depreciation schedule. Your assets get written off over a number of years, but often if you look at your depreciation schedule that's being used for tax, you'll find there's leftover old assets that have been long since scrapped, disposed of, or you don't even know where they are. Now would be a good time to get them written off, and if there is anything left on them, to be able to claim that as a deduction. Superannuation, if you don't have to pay that till 28th of July, but if you want the tax deduction this year, you need to pay it before 30 June and make sure that it's paid enough before 30 June it actually gets into the superannuation fund before 30 June. It can't just be mailed off at 30 June, it's going to be at the super fund. You may want to bring, now for, as you're not a small business entity, prepayments aren't helpful to you, but you could actually be doing things like, are there some just normal expenses, be it stationery, possibly repairs, those kind of normal running costs for business? Could any of those be done now rather than, if you're going to do them in July anyway, why not consider doing them now and get the tax deduction in this year? Same for things like consumables, be it for photocopiers, be it for printers, be it for equipment you use. Consider buying your consumables you might be needing over the next 2 to 3 months now. Because I think at the moment one of the issues is with your financials and your tax is to you want to save some tax, but you also don't want to mess up your cash flow. I think at the moment cash flow is still very important. So you need to be mindful, like if you're making massive superannuation contributions because you can, what impact is that going to have on your cash flow? Is that the best thing to be doing right now? Not that you shouldn't do it, but just monitor your cash flow as well. So that should do it for the minute. Bye.